And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
To the show, of course, it's the Hump Day edition of The Real Investment Show. Get by our website today, realinvestmentadvice.com. Michael Leibowitz's new article out on Janet Yellen and the measure of hope, right? There's, lots of discussion lately by her in particular, like no recession in sight. So he does some good analysis about hope as a precursor for monetary policy. And then it's kind of an interesting piece. So anyway, that's on our website now, realinvestmentadvice.com. While you're there, make sure and subscribe to our weekly newsletter and to our new Before the Bell channel. That's our new YouTube channel where we do our 3 minutes on markets and money every morning. So make sure you're subscribed over there. We've now got this channel. Make sure and subscribe here as well. So if you're watching the show, click that little bell icon. We'd appreciate it. But also subscribe to our Before the Bell channel so you get all of our videos that we put out every day pre-market. So that'll help you manage your money better. Okay, so a couple things. Big news yesterday, of course, inflation data. Coming in a bit hotter than expected. Shelter inflation, 8% year over year increase. And again, that's the highest level since like the 70s that we've seen for shelter inflation going up that much. But, that's continuing to weigh on the inflation data itself. Inflation data coming in about 0.5% yesterday, 0.5% yesterday on the increase. Year over year, still fairly elevated, well above 6% at this point. So, this is going to keep the Fed, and this, the market kind of shrugged this off initially yesterday morning, came in line with estimates. Markets kind of rallied for a moment pre-market, and then kind of sold off, but then rallied back, intraday. And again, we just kind of remain above this 20-day moving average, kind of keep coming down and testing it. But markets kind of shrugging off yesterday this hotter inflation print. Not sure why, because when you take that inflation print yesterday combined with those employment reports for January, there is no signal here that the Federal Reserve is going to stop hiking rates anytime soon. And this is going to continue to tighten monetary policy. And the big concern, of course, is that the Fed hikes rates too much and they break something. And this is going to be the real issue for markets at some point later in the year. Because again, when we start talking about the market itself, right? What do we invest in the markets for? So when we invest in the stock market, yes, I know everybody wants to get wealthy. That's not my point. We invest in the stock market because we're making an assessment on future earnings of companies, right? So if I buy Apple stock today, what I'm really kind of betting on is that the price that I pay for the company today will be worth more tomorrow because of improved earnings, right? They're growing their business, they're successful, whatever it is. We're always betting on an optimistic outlook for that business. And that's why we make these investments into markets. And yes, and then ultimately that leads to more wealth. That's the point, right? But the problem is that higher interest rates, this is the disconnect between what's going on right now. Higher interest rates impact corporations on a variety of different measures. So first of all, higher borrowing costs, right? That eats into my profit margins. So when I report earnings, I have less money because I've been spending more on funding debt. So if I've got to refinance debt at higher rates, that's going to eat into my earnings flow, right? The other side of this is higher interest rates detract more capital. And again, when the Fed hikes rates, it doesn't really affect the long end of the curve, right? So when you start talking about 10-year treasuries or longer dated corporate bonds, the Fed funds rate change doesn't really impact that much. What the Fed funds rate does is impacts the very short end of the curve between 0 and 2 years. Very high correlation between interest rate movements between 0 and 2 years and what the Federal Reserve is doing. But that feeds into the economy in a couple of different ways. One, it changes the prime rate. The Federal Reserve has a very sharp impact on the prime rate, which affects things like credit cards. So now we're consumers, which is 70% of the economy, by the way, they're never got higher payments, monthly payments on their credit cards because their interest rates go up. Well, that takes more of disposable income away to service debt versus what I can go buy stuff in the economy for, which ultimately comes back and impacts earnings. So the point of higher rates and tighter monetary policy, as we've explained before, is to reduce consumption, which thereby reduces earnings for corporations. Yet what investors are betting on right now is better earnings later this year. Right? So the expectations is that this is the worst. Right now, we are at the worst of the earnings decline. But yet the Fed is still hiking rates. So here's the logical question. How can you be at the worst of the earnings decline if the Fed is still hiking policy? Right? That's the disconnect that's going on between the markets right now. Again, we talked about yesterday that the markets are hoping that the Fed's going to be cutting rates by June or July. But again, there's another disconnect, because if the Fed's going to be cutting rates by June or July, that suggests that the economy and the markets are going to be in a bit more trouble. So why are we running prices up in anticipation of a pivot in Fed prices? Because the only reason the Fed would start to cut rates, the Fed's just not going to cut rates because, right? The Fed's going to cut rates in order to offset a recession or to offset a financial crisis or whatever it is. But there's going to be a problem, and this is why the Fed will be cutting rates, then trying to get consumers back into the economy, right? They need to offset a recession, so I need to cut rates to give consumers more money to spend so they'll get back out into the economy and start creating some economic activity. If everything is fine, if you have a soft landing in the markets, if markets are going up, if the economy's doing okay, why would I cut rates? There's no reason to, right? So this is the disconnect that keeps going on between the markets. And again, doesn't mean, that the markets are entirely wrong. Maybe the markets are sensing something and picking up on something that logic is missing. But just from the standpoint of a logical assessment of what these Fed rate hikes are going to do and what inflation is going to do for the economy over the course of the next several months, it's hard to suggest that the markets have this right now. But again, we have to give the market room to tell us what it wants to do. This is the conundrum. We spoke a little bit about this yesterday on the show. Paying attention to what markets are doing. Right now, the market trend is positive. The 20-day moving average has been holding good support here. It's been a good marker of this rally ever since December. Lots of support, as we've talked about over the last few days, right there at the 50 and 200-day moving average. So again, market's going to be opening down a little bit this morning. We're going to come down and retest this 20-day moving average again this morning. We'll see if it can hold or not. But as we discussed yesterday, we do have a sell signal now on a couple of different levels, so it's very likely this correction or consolidation process has started. And the one risk to be paying attention to is if we go back and look at previous peaks where markets were consolidating like they are now, we saw the same type of kind of volatile action as we were getting that initial sell signal, and then eventually the markets kind of gave up the ghost. We saw this previously back over here in August as well. Markets kind of consolidated, rallied a bit as you were getting that sell signal, and then finally gave up the ghost on that as well. So again, be a little cautious here. We've got the same type of consolidation process going on as we're getting ready to trigger that sell signal from a decently high level. So again, a bit more of a correction is likely over the next month or two as we kind of go through this, particularly as we get into March and the weaker part of February, which is the last half. So again, a couple of things to talk about. Now, this morning, Danny Ratliff joining me. We're going to be talking a little bit about, you spend all your years accumulating savings, right? You work hard, you save, you invest, you grow your nest egg. When it comes time to spend it, you don't want to because you're so worried about everything else that's going to happen. So we're going to talk today about how and when to spend your nest egg. Talk about that with Danny Ratliff coming up right after the break. Real Investment Advice is the website. Get by there. Get our latest blog posts, newsletters, more. It's all there for you to help you manage your money better. RealInvestmentAdvice.com. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We teach our kids the alphabet and all the colors too. But raising our kids to be money smart is really up to you. Our next RIA Lunch and Learn will dwell upon this topic, because teaching kids to manage their coins puts money in their pockets. Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Just want to warn you, Brent, I have a rant this morning. So we're going to get there. But before we get to the rant, we'll start out with Danny Ratliff this morning. Good morning, Danny. How are you?
Hey, good morning. I'm going to hear this rant.
But we'll save it, right? We'll get to the rant.
I don't know.
Here.
I feel like we need to give you a little time to really air this all out.
I just read an article, so I'm getting all fired up right now. I'm processing at the moment. Stupidity reigns in the financial marketplace. Anyway, we'll get there in a minute. So, you spend all your life, right? We talk about this a good bit on the show, right? How to invest, how to make money, how to save for retirement, all these type of things. I had a good email the other day from a listener. Appreciate the emails. As always, if you want to send us an email, we're always happy to have them. Go by our website, realinvestmentadvice.com. There's a little box right at the top that says ask a question. So feel free. Send your questions, comments. Never know. We might answer you. No, we answer all of them. But, the issue is he makes a good point. He's like, look, we've been saving money and doing everything right and, paying off our debts and all this, getting ready for retirement. And now we're getting to the part to where we're supposed to be spending the money, but it's hard to do it, right? It's hard to dip into that nest egg for retirement. And it's an interesting psychological problem that people run into is you spend all this time and effort and years, accumulating this nest egg, and then you start worrying about, well, what if I spend too much? Or, what if this happens and, I'll lose a bunch of money, then I won't have it to spend. And so you kind of become this hoarder of your retirement accounts, and it becomes a bit of a challenge, right, to actually spend those savings. And Danny, I think you run into this probably more often than about anybody with clients that you work with.
We do. And the financial industry does an extremely poor job of talking about distribution mode. Like, what does that mean? How do you get there? Most financial articles or any information that you find is really talking about how do you accumulate? And we probably don't do as good of a job at that as we should as an industry as a whole, which is why we talk, like Richard and I on our Financial Fitness Friday shows right here. We talk about this frequently in a lot of our workshops. How do you distribute? How do you get there? And what should you be thinking about prior to going into retirement? Because many times, and here's the problem, Lance, we're saving funds, and all of a sudden we're supposed to just flip a switch, and boom, you're now went from an accumulator to a distributor. And this is so tough. because you've spent all of your life doing one thing and then you're just expected to make this change and not be a problem. And we call it the black hole, that first year or two. And a lot of men really struggle with this is one, I mean, there's a number of things that go into this and probably need more of a degree in psychology than finance to really appropriately address this. However, we lose our sense of purpose. This is anybody when you quit working. You have to have kind of a game plan set up. And a good planner will help you discuss these issues prior to going into, that retirement mode where you begin to think about this. How do you distribute funds? And hopefully you've been working with somebody long enough that they can actually give you an idea where you should be putting those funds to give you more flexibility in retirement. And so we encourage a handful of things. One, you need to really sit down and dive into the qualitative issues, because what happens, I think, Lance, is that, the root cause of this problem is not just, saying, okay, flip the switch, let's start distributing assets, but it's the failure to actually probably prepare in many ways, right? Everybody knows their numbers. Everybody knows the financial numbers. But what they don't think about is how they're going to use it further down the line and where do those funds go. So, we talk about things and people are like, well, why do we need to talk about what are my hobbies going to be? What are we looking to do in retirement? Because, that's where your money's going to go. All these goals, objectives, everybody wants this magic number, but the magic number is tied to all those magical things you want to do once you get to retirement. And so by getting a really good understanding, starting to prepare for it, I think it really helps a lot of people. And we do have some clients that do a trial run. It's not for everybody. And this is one thing that I think that the more people that do this, you'll actually end up being a little bit better off because you have an understanding, you actually start to see funds come out. But what we'll do in these instances is as you're still working, you're winding things down, you start putting funds into a separate account. But then we begin to draw down on one of the investment accounts that you're using, if you have the flexibility to do so, right? Some people, Lance, they just have everything inside the 401k. Yep. There may not be a ton of additional savings or other avenues to distribute. And look, that's okay. That's why I say it's not for everybody. But if you do have the luxury of doing something like this can help kind of set your mindset, get that right, and start to see how this actually works. Now, there are times, because we do a lot of distribution planning, a lot of different strategies surrounding this, that we may say, hey, you have all these additional funds that are after tax. You have potential bonuses coming in. You're still working for part of the year, where we may encourage you to wind down after tax funds first, meaning like, savings accounts, after-tax brokerage accounts, taxable accounts, right? And then towards the end of the year, once we have a really good understanding as far as what income is, to make a larger distribution either via Roth conversion or just a regular distribution. But we fail to prepare on this in so many levels, Lance, and this is a big issue. Well, I'm glad somebody brought this up.
Well, I think it's, there's some other, psychological, and again, it's all psychological. Right. I mean,
so much so.
The math is pretty easy. If you have X and you take out this much a year, it's going to last you this many years, and you should be dead by that point. So that's pretty easy math. I think the problem that we get ourselves into is that we start overthinking things. Right? It's like, well, if I take this money out now, what if I have a medical issue coming down the road that I didn't count on, and what if I have some other type of issue, or what if if I have a family member that passes away, whatever. There's all these other things that can.
And I've seen every one of those things happen.
Right. And so how do you plan for the unexpected so that I can sit there and kind of comfortably say, okay, I'm going to take out X a year, but then still have this emergency pot over here just in case something goes wrong? Well,
I think you always have a buffer. You have some type of buffer within the plan to say, okay, what are the miscellaneous expenses that can come up? And this is why we always encourage, the hierarchy of savings. One, we want to make sure you have cash on the sideline. You have your emergency fund. Everybody talks about that. But then, we can go a step further and say, well, rules of thumb, which are good and bad. But, some may say you need 6 months. Some will say you need 3. Some may say you need 12. Well, it's going to vary. If you're in a position where you're commission-based and income is very volatile, or even your industry, well, then maybe we want to have you put a little bit more aside. Versus if you're a tenured professor and you can do no wrong, you're going to have that paycheck coming in.
Right.
Well, then maybe you don't need as much. But we've been encouraging for the last several years, Stephen, to accelerate that and have what we were calling a financial vulnerability cushion, meaning that we want our emergency funds. And those emergency funds are ideally, they're typically there if your car breaks down, the AC goes out, you lose your job, give you enough time to go and find another job. But what if we went above that and put additional funds aside? So if all those things that happen at once, it gives you a little bit more bandwidth to protect yourself. Mm-hmm. And so I think that, having that hierarchy of knowing where to go and maybe adding an additional expense within your financial plan, because we're going to get sideswiped by stuff. Life's going to throw us curveballs. Now, if it's a huge deal, we want to do a side-by-side comparison within the plan. Hey, here's some routes that you can go. Here's some other avenues that maybe or resources you could tap to meet these short-term needs. But that's the tough part, because how do you plan for the things that may or may not happen? And that's where I think you put a little bit of an extra buffer within that plan.
Yeah. Well, and this is also where, you can also mitigate some of those risks with some good insurance planning, right?
Correct.
Long-term care, disability insurance, things that, none of us want to talk about because it's, it's mortality. It's also where an annuity, and now with interest rates up, the payout on annuities is some of the highest levels we've seen in the last, probably 10, 15 years.
Oh, easy.
But that's a guaranteed income check at retirement. So forever. I mean, until you pass away. So, that's going to, you can fund, if you say, look, I need between Social Security and what I might get on my pension, or if you have one, or any other type of payout structure you're getting from another source, between that income and my daily living needs, I need an extra $2,000 a month. You can buy an annuity. They'll guarantee you a check of $2,000 a month for the rest of your life. So you can have that. It's kind of what I call an Alpo diet. It covers everything except food, right? You're just eating Alpo at that point, but everything else is paid for. House is paid for, cars paid for.
I get to cover food.
Daniel,
we don't want you eating ramen noodles or dog food, okay?
I'm just saying it covers, but the point is to cover all the basic necessities, and then all you have to worry about is just the minor stuff, right? Food, correct, entertainment, that type of stuff, after that. But so there's a lot of ways to mitigate some of that risk, but it's just part of the planning process, right?
Yeah, and I think you have to be cautious with that, right? We hear good and bad about all these different types of products, but it needs to be, you need to have an extensive toolbox that you can go to, and then you can utilize at different times, and what may be good for your neighbor may not be good for you, and everybody's situation is a little bit different. But I think getting back to the issue here is, it's like, we do these workshops, Lance. I tell people, look, my kids, they practice everything: piano before a piano recital, t-ball or baseball before big games. But yet we don't get that practice or trial run in retirement, really. And now there are people that, you could say are blessed that they have the ability to do so, but that's just often not the case. I mean, sometimes, we saw during the pandemic, we had a lot of clients who were let go of work, said, look, we always fall back on our feet, we'll be fine. And that just wasn't the case. They're out of the workforce now. But they had to change lifestyle. They changed, housing, expenses. They got a taste of it. And some of them now have gone back to work. They're able to find work again, but some didn't. And so you get this trial run sometimes where you get to good understanding. In fact, I have a client who, she retired and kind of didn't have to, or really didn't have to, but really wanted to, then determined, you know what, I want to do something. I shouldn't want to do that. And has done all kinds of kind of odd jobs over the last 2 years, and finally found something she really likes. And so it's kind of a neat phase in life where you can actually kind of step into something because you want to do it, not because you have to.
There you go. All right. Come back from the break. Pick up on our morning's rant. We'll talk about that. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
We teach our kids the alphabet and all the colors too. But raising our kids to be money smart is really up to you. Our next RIA Lunch and Learn will dwell upon this topic, because teaching kids to manage their coins puts money in their pockets. Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
See, there you go on Fox right now. Otters are becoming artists for Valentine's Day. They put ink on the otter's feet and let them run around on paper, and then they make an ottergram out of it. Don't ask me why.
My puppy does that with poop.
You just keep that story to yourself.
The Real Investment Show podcast. Same show, your schedule.
You know what, though? They're going to make millions
Yeah.
off that.
Yeah, they will.
Because happy extortion day.
At realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So actually this morning I have two rants. We'll get to both of them this morning. When the markets are going up, we saw this in 2020, 2021. We're actually seeing it again today, right? There's, a lot of stocks that are up 100% from their lows back in October. Now, that's not saying a whole lot, but, there's a lot of stocks that are, have risen sharply because speculation is coming back into the markets in a variety of different manners. And, one of the issues, though, and again, there's all these stories. We've told stories before, like in 1999, Dallas, the Dallas Morning newspaper, they would get a longhorn steer out and they taped his grid off on the ground, and they'd put stock symbols in the grid, and wherever the cow pooped, that was the stock pick, and the longhorn steer outpicked the pros. Because that's the market we were in. There's another story about a blindfolded monkey that was a better stock picker in 2001 than the pros. And that's what happens, though, when you get into these kind of speculative environments and where things are just kind of going up and money's just chasing things at willy-nilly. But, the other problem that comes in from the markets is that in order to sell product, right, advisors and Wall Street in general, they make things overly complicated because the whole goal is you're too stupid to manage your own money. You have to use these really sophisticated, complex models of all these different funds and you have to have this type of allocation structure, et cetera. And that's not really necessarily true. I'm actually writing an article I told you yesterday on conviction, and how conviction to an idea like the world's going to end or the dollar's going to go to zero, whatever it is, can really put you on the wrong side of the trade. And, it's kind of the same thing that was used for a long time in the markets as well. You have to own a little of everything. You need diversification, right? You need to have all these different assets to make sure you're diversified, because that way, if the market goes up or down, you kind of participate, but you don't get hurt. And that sounds great in theory until the turn of the century, when we had blindfolded monkeys and longhorn steers picking stocks, and correlations pretty much went to 1. It didn't really matter what you owned. Everything went up together. Everything went down together. Since 2009, being diversified in anything other than the S&P 500 or the NASDAQ has cost you money. If you've had emerging markets or international or gold or anything else, you've deteriorated your returns over time because all the money flows were going into the United States. So, the point is that investing doesn't have to be complicated. But in order to sell you stuff, and I hear these advertisements on radio and TV all the time, it's like, you need to have this structure and that structure, and the world's too complicated, and you're not smart enough to manage your own money. And that's why you have to have us, right? That's why you have to have us manage your money. And the reality is that managing money in a portfolio is not difficult, and it's really not complicated. You just have to pay attention to what's going on. And that's why we talk about technicals and those type of things. These aren't complicated issues. It's just things that you have to pay attention to. And then overlay that with a really strong financial plan, so you have a goal of where you're actually trying to get to. The reason that people take on too much investment risk over time is because they don't really have an end goal. They're just like, I know I need a bunch of money to retire, so I'm going to take on all this risk right now so I can have all this money to retire, but they really have no idea if it's $1 million or $2 million or $10 million. And Danny will tell you, and he will tell you here in a second, we have people that retire on $500,000 a year or $500,000 in assets, and they retire just fine. And then there's people with 10 million assets that can't retire, right? So it is a function of your underlying lifestyle. But not having that goal of where I need to get to pushes us to take on too much risk. And risk is a function of how much money you lose when you're wrong, not how much money you make, right? And so investing isn't complicated. And we look at a lot of portfolios that come in from other places all the time, and it's like, what do you got going on? I mean, another big mistake and I'll turn it over to Danny here, but another big mistake on diversification is I'm going to have 10 different people manage my money. I need it diversified. That's a terrible idea. And the reason is that you don't have any correlation between what all these different advisors or managers are doing for you, and you create a bunch of overlap risk because they pretty much all wind up owning the same thing. So there's just a variety of issues that you really need to pay attention to. Simple is often better, Danny.
Well, I agree, and I think I've seen some that are give you the illusion of being simple because maybe there's not a ton of positions. And ideally, we don't want a portfolio with several hundred positions, which I do see. We see this. There's a handful of really big firms that will buy all of these positions, and at some point, you're just tracking the market. And then the fees add up because typically they're charging you a fee. Then they're hiring an outside money manager that charges you another fee. We see that a lot too, right? So you see a lot of overlap. That can be an issue because why not just go buy SPY or go buy, which is something we've owned in the past, just an S&P 500 ETF. I mean, there's a lot of ways to play that game. Now, you want to be cautious because I do see this with a lot of mutual funds as well. And we lose a lot of tax efficiency with mutual funds and some control. But, I visited with somebody yesterday and they had a portfolio which ideally didn't look overly crowded, meaning that there wasn't 100 positions or several hundred or even, 50 or 60. But what it was is a lot of mutual funds that were very similar. And this was a wrap account, but some had A shares, so transactional shares, right? You're paying an upfront fee. Some had C shares, which are really expensive, right? You start getting into the internal expense ratio is pretty high. Like we started looking at just kind of playing devil's advocate, looking through all this, said, man, this one's 1.4, this one's 1.6, this one. And so that's on top of a management fee. So now the hurdle has become that much higher for you to succeed. And so like our goal is to make sure we keep costs down. We're always acting as a fiduciary. We are, if we're trading in somebody's account, we're not getting paid for it. We believe it's because it's going to protect funds or grow them. But I think that we have to be mindful. And when we look at some of these portfolios, like, this was somebody who, was somewhat moderately aggressive, I would say, and had bonds, but all the bonds were high yield. And, in different environments, they're going to trade just like a stock.
Right.
And so not nearly as risk averse as what, when you look at a portfolio breakdown, is what it would elude. So we have to be really cautious when looking at this. And look, in any advisor's defense, it's easy to pick apart a portfolio. You can pick apart anything, right?
Yeah.
I mean, and say, hey, here's good, here's bad, here's why. Everybody has a little bit different flair to it or what they're trying to accomplish or do. And there's many different ways to get there. But I think where, you mentioned the over-sophistication. You get a lot of these places that they create product for the next biggest thing or for the thing that was big last year, the idea, the theme, whatever it may be. And, hey, we're going to have this account, this account, this account. And it's difficult sometimes to understand how it all works together. And so I think this is where, you mentioned a financial plan, taking that inventory of assets, understanding how asset allocation works together. And I don't mean just diversification, right? Because that's what you're always going to hear. You got to be in large cap, mid cap, small cap, international, emerging markets. And then, we'll tweak it a little bit if we don't like that area. We'll reduce it by 2 or 3%. If we really like it, we'll overweight it. Well, if you don't like it, why are you in it?
Yeah. Well, and again, this is analysis. Look, there's a tremendous number of really great advisors out there. So don't take this as a blanket statement that all advisors do this, because that is not the case at all. But I think the things that you have to just ask yourself is that if your advisor is putting you into a lot of mutual funds, right, and the thesis is buy and hold, why do you need an advisor? If you're just going to buy and hold mutual funds, which all have managers, right?
Well, that's the kicker, right? I mean, like we look at a lot of them, and they haven't traded in years,
right? And so what are you paying the advisor for? Well, I'm paying for the financial plan. Okay, that's fine. There's nothing wrong with that, as long as you're okay with the buy and hold structure. And it's just things to think about. Is saying, okay, look, what am I paying for, and what am I actually getting? And there's just been a lot of development over the last 15 years, 20 years in the markets, which prior to 2000, advisors were paid to manage money. This is what we did. And we were paid to track the market and make investments in these type of things. And then after 2000 really came this evolution, particularly of the younger advisors that were coming into the markets and the big brokerage firms, right? The JP Morgans, the Wells Fargos, et cetera. They said, forget all that, right? Because we started going to decimalization of the markets and commissions were cut and all this type of stuff. And so it made it much less profitable to manage money, right? Why am I going to pay Danny, $500,000 a year as a salary as a portfolio manager or whatever he gets paid to manage that portfolio when I can just get rid of him? And we come up with these models where just say, pretty much you're in this model of 15 different mutual funds. You'll kind of track the market up or down. And the premise is you just kind of buy and hold. And that eliminates the whole need for having to have sophisticated portfolio technologies and all these type of things that cost money, right? It reduces that cost. So as fees came down, the market environment, Wall Street came up with ways to cut the cost to keep that profitability on you, right? So this is the important thing to consider. So just the point of the conversation is just be careful. Make sure that you're the value of what you're paying for is there. And if it's not, there's other alternatives. And again, there's nothing wrong with doing it yourself. Managing money isn't hard, right? You just have to work at it. Well, so like anything else.
Yeah, but it can be extremely overwhelming. I mean, think about how many vehicles there are to invest in. I mean, there is a different type for everyone. And determining what's best for each person is probably difficult. Without, I think we take it for granted because we're in the weeds every day.
Right.
But most people aren't.
But this is where you go back to a good financial plan too.
Correct. Yeah.
All right. Second rant of the day coming up right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We teach our kids the alphabet and all the colors too. But raising our kids to be money smart is really up to you. Our next RIA Lunch and Learn will dwell upon this topic, because teaching kids to manage their coins puts money in their pockets. Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, I got a little rant today. You know, I've talked before about the myth of stock buybacks being a return of capital to shareholders because, again, if Apple buys back their company stock, did you get a check in the mail? Right? Did anything show up in your account because they sold, they bought back company stock? No. Now, dividends are a return of capital to shareholders. Why? Because you actually get a check, right? If you're in a DRIP program, a check shows up in your mailbox, or you have a deposit into your bank account. That's a return of capital to shareholders, right? Buybacks aren't. What buybacks do, though, is increase the wealth of corporate insiders. And the SEC is now taking some aim at this. They are now reviewing what's called the 10b5-1 rule, and this is a rule that affects individuals of insiders of corporations when they buy back stock. And what you're supposed to do, and this is just very quick in a nutshell, there's a Wall Street Journal on this if you just Google 10b5-1 Wall Street Journal. What you're supposed to do as insiders, you file a plan, and Danny deals with this from time to time with our clients as well. But you have to file a plan that says, I'm going to execute the sale of my shares over this time frame, right? On certain periods, I'm going to sell my shares, et cetera. And you have to follow this plan, right? And then you're supposed to follow the plan.
They typically only have certain windows as well when they can do so.
Right. And you're supposed to adhere to this plan. Well, what the SEC is now reviewing on this rule is that I'll just clip it for you. Among the highlights, officers and directors will have to wait at least 90 days after starting or modifying 10b5 plans. Some insiders were selling shares less than a month after adopting their plan, sometimes even the same day, or adopting and initiating trading plans right before earnings announcements. Wink, wink, nudge, nudge. Like they have no idea what they're about to announce. Another trick has been to adopt multiple 10b5-1 plans and later selectively cancel the ones that wouldn't work to the insider's benefit. You get my point? Right? So SEC is aiming to change this a bit. But this goes into another picture, and this now you have to jump with me for a minute. It goes into climate change.
And here's the rant.
Poor people don't care about climate change, right? Look at who are the biggest polluters in the world, right? China, India, South America. It's where the majority of poor people live. They don't care about climate change. They're just trying to make ends meet, right? They're just trying to feed themselves. They don't care about climate change. Who cares about climate change? Rich people. Why? Because there's a massive amount of money in climate change. And for companies involved in that, I gave you an example. My wife sells LNG. And so they have what's called bio LNG, which is LNG that is produced from pigs and other type of poop, right? And so it's natural and organic and whatever. Anyway, it's climate friendly is this bio LNG because you're not harvesting it out of the ground, right? So this is supposed to be better for the planet. Well, if I want to get the bio LNG from point A to point B, I've got to do what with it? I've got to put it into a pipeline with every other LNG that's in there. So when I get the pipeline, the gas at the other side, unless I truck it, right, then that's a different story. But the point of it is I get what's called a carbon credit. Now, I've explained carbon credits to you before. Danny has a company. He's from West Virginia, and he has a coal mine. The worst. He doesn't even do clean coal mining anymore, right? He's doing it the way they did back in the 30s. I mean, it's just the nastiest form of coal mining on the planet. I mean, he's just destroying the planet. He has a zero carbon footprint. How does he have a zero carbon footprint? He's doing he's mining coal, picks and shovels and the worst kind, right? He's not even close to clean because he buys carbon credits. So companies like Tesla that have a, environmentally friendly footprint, they get carbon credits that they can then sell to Danny so Danny can reduce his carbon credits. Okay, let me explain to you this in real life. There is a company that is cashing in on climate change. One of the most important technologies to address climate change got a boost on Thursday when a startup said it pulled carbon dioxide from the air and stored it underground. The company has cashed in. You're hearing the words here? The company has cashed in on the effort, potentially creating a viable business model that could kickstart a brand new industry. ClimateWorks AG is the leader in the race to remove carbon dioxide from the atmosphere using a process known as direct air capture. This all sounds good. Customers include Microsoft, who paid a significant premium. Pay attention to this line. They paid a significant premium to buy carbon credits guaranteed and generated by ClimateWorks. So how does ClimateWorks make their money? Selling carbon credits. So who's the beneficiary of climate change? Rich people. That's why there's a ton of money to be made selling climate change. Now look, I'm not against doing things that are good for the atmosphere, but let me explain to you the ClimateWorks function, how this is what this company created. They created a box that basically sucks the air out of the atmosphere, right? It then strips out the CO2 and then produces CO2-free air on the other side. It then stores the CO2 in a filter, and then they heat it up to several hundred degrees, and it crystallizes it. Then they pump it underground where they can be stored there for thousands of years. Now, there's a much cheaper way. By the way, the whole heating process required another energy company to produce the electricity to create the heat. But there's a much better way to do that. If I want to remove CO2 from the air, plant a tree. That's what trees do. They need the CO2 to take in the CO2 and produce oxygen, right? That's how we all live and breathe. Guess what the problem with that is, though? Trees don't produce carbon credits, and they don't produce any revenue. And they're cheap to plant. So the point is that, this is all great technology, right? I got nothing against it, but the scam in this is the carbon credits. I produce a technology that doesn't really lower the footprint of what's going on outside of what planting trees would do. And I make billions of dollars. Now, who's going to benefit from this? Corporate insiders, corporate executives, et cetera. It's all great, right? And
people creating the pollution.
And people, yeah.
In their private jets.
Exactly. Bill Gates says that he should be allowed to have his private jet and fly over the world and do this because he's contributing to reducing climate change. So his carbon footprint doesn't matter. It's a net cost. The point is that this is part and parcel, and then goes back to this whole 10b5 plan, et cetera, how corporate insider. This is why people hate capitalism today. If you look at TikTok and all these other social media channels, there is one person after another, disparaging capitalism. Capitalism is evil. I saw a TikTok guy the other day talking about how capitalism is killing people. No, capitalism isn't killing people. Now, the guy's dressed in a T-shirt with shorts, sitting in his mom's basement, disparaging capitalism. Another guy was out yesterday as well talking about how he shouldn't have to work. Right? There should be free health care, should be free food, free basic essentials. You should be able to live your life without working. If you want more than the basics, then you work.
Who's going to provide that, though?
Well, this is the illogic of all of this, right? But the point is that, when we go back to look at the core structure of 10b5 rules and insider buying and stock buybacks and corporate, and these climate change credits and all these things, when you actually dig down to the core of all of this, it all has to do with making money. Guess what? That's capitalism. But this is the thing to understand. So look, if you really want to cure climate change, if you really want to reduce CO2, go plant some trees. It'll work a lot better.
Feel better?
I feel better. I had to get my rant
Good
off
job.
this morning. These things just infuriate me because as soon as you start reading the first line and it says, creating a viable business model that could kickstart an entire new industry.
Yeah.
That tells you all you need to know.
Here we go.
So anyway, we'll have to clip this part of the show out and not produce it. So,
Oh, no. We'll clip it and post it separate.
you get a shadow ban by the all-seeing multi-trillion-dollar corporations of Google. Anyway, all right, Danny. Last thoughts.
But going back, you talked about self-responsibility and really what the lack thereof. If people want people to take care of them, that's a problem, right? We need to be responsible for ourselves, our actions, what we do. And nobody wants to do it anymore, right? That's why get-rich-quick scams are so prevalent, because everybody thinks that, hey, we don't want to put in the work, the time, the energy to do the right thing, and that's the frustrating part. I could go on a rant for a while on this, but that's a bigger issue.
I know. And the other side of this is if we did this, this carbon capture thing, this company wants to do, and we did it on mass scale and sucked all the CO2 out of the air.
Yeah.
What are trees going to survive with? Plants, vegetables, farms.
Well, look, man, Bill Gates has his, what is it? All they're doing
he's the
Beyond
largest,
Meat.
Bill Gates is the largest farmland owner in the United States.
Yeah, but not using it for farming.
No, he leases it out to other farmers.
No. But I think what his intent is different from most, right? Because they're manufacturing actual food,
right? Not
growing food.
Yeah, true.
So it's a little bit different.
That's true. Anyway, all right, that wraps up the show for the day. Get by the website. It's a rant-free website today, by the way. So far. Talked about how the correction had started. That's our Tuesday blog post today. Michael is out today with his post on Janet Yellen and hope that we will not have a recession. That's all on the website right now, realinvestmentadvice.com. Send your questions and comments, of course, as always, to the website, realinvestmentadvice.com. And make sure and subscribe to this channel as well as our Before the Bell channel. That's our new channel for 3 minutes on markets and money, which will be coming up here in just a few minutes before the bell opens. So make sure you subscribe. Just click that little bell icon. All right, have a great day. We'll see you back here tomorrow. Michael Leibowitz will be here to talk about the Fed, inflation, and, of course, what do we go from here as the Fed's next meeting is not too far off as well, and what that's going to mean for rate hikes in. All right, see y'all tomorrow. Have a great day.